All right, welcome everyone. Thanks for walking through the poll with us. You can see we've got a little bit of a range, but definitely have some folks in the middle here. So we've got two that answered higher than 8%. Let's see if that's 5 that answered between 5 and 8%, 4 between 2 and 5, and 1 that answered below 2. So thanks again for walking through the poll. I think by the end of this session, you should be able to have a very good idea of what to expect with inflation. Certainly we can't project the future, and that's not what we're trying to do. But we hope to just shed some light on what has happened in the past, what is happening right now, and what we think should happen over the long term, over the next 20, 30 years. So with that, glad to be joined again with Adam, just like last quarter, and we plan to do this every quarter to do a different topic and answer questions and things like that. So with that, we'll get right into the slideshow. And again, thanks everyone for being here.
Absolutely, yeah. So let's kick it off. So first we got some disclosures to put up on the screen just to reiterate, we're not predicting the future or anything here. I'm just kind of trying to provide some context. But the first thing that I thought would be interesting is, so these are kind of the inflation expectations that are baked into the market. So I thought it'd be really interesting to get your guys' feedback kind of on what you're expecting. This is sort of, what the market is pricing over the next 5 years in terms of inflation. And the thing to remember there is it's a 5-year average, right? So the market's pricing 2.44% over the next 5 years. But that doesn't mean that it can't be, 7% next year, and then maybe 1.5% in some out years to come out to an average of 2.44. But I thought that was kind of interesting. We kind of had a handful in that middle range. And again, on the left there, that's sort of what the market is predicting.
And when we say the market is predicting that, what exactly, what data are we looking at right here?
Yeah, it's a good question. So there's two types of government securities. There's kind of just plain bonds that the government issues. They're borrowing money from the public, and they pay a stated interest rate. And then the government also issues something called TIPS, which is similar to the other security. The only difference is it pays inflation. So if you hold a TIPS security, the government's going to pay you some amount plus inflation. And so if we look at the price of those two securities next to each other, we can say, okay, how much would future inflation have to be for you to be indifferent between holding a TIPS or just a normal government bond, right? And so if inflation is higher than that number, then you can make a whole lot of money by holding the TIPS instead of the government bond. If inflation was lower than that number, you could make a lot of money by holding the government bond instead of the TIPS. So it's sort of where the market is pricing future inflation to be is that 2.44% over, again, 5 years, which means it could be a lot higher in the early years and then come down in the later years. The other one I have up here on the right, it's a little harder to see, but that is actually a survey of consumers that the Fed does. So they go out and ask people, what do you think inflation is going to be over different time periods? You can see over 1 year, the average respondent to that survey said, close to 6-ish%. Over 3 years, the average respondent to that survey said closer to 3-ish%. And so again, they're not asking economists, they're just asking everyday people in this survey to try to get a sense of, what are people thinking out there about inflation in the economy.
It's great. And just a reminder, this is FRED data. This is data that anyone can go out and grab. You can grab this exact chart by the link at the bottom of the slideshow. AJ, I think we could send this slideshow out, prior or excuse me, after the webinar. If anyone's interested, just let us know and we'd be glad to send you this data. And finally, I just wanted to tell everyone this webinar, we are going to go pretty deep into inflation. We are going to hit a couple client questions near the end that have more to do with the market. But for the next 20, 30 minutes, we're going to dive really deep into data, into inflation. So just fair warning, and it'll be fun. So
absolutely, yeah, we're kind of nerding out on this one a little bit. And so, like Jake said, I want to dive really deep here. And the thing that's tough about inflation is it's different things to different people. There's different ways to look at it. You can look at it year over year, month over month. There's a number called core inflation that excludes, energy and food. And if you're somebody who likes to eat food and has to have gas or to make your car run, you're probably wondering why there's an inflation number that doesn't include, food and energy. But we're going to dive into all those questions. But what I wanted to say first is there's really two reasons inflation might matter. One is just for everyday people, right? If you have a bank account, you have cash in that bank account, or if you have just dollar bills in your wallet, if inflation goes up, that means those dollars are going to buy less stuff in the future. And so just from a standpoint of being a human being that has money anywhere, inflation is going to, negatively impact you if it runs high. But there's a whole other reason, which is, primarily our relationship with clients is, okay, well, how does inflation impact the value of their assets? And that's a slightly different thing, right? And so on the left side is kind of like a consumer, how does it impact the cash in their wallet? Where on the right side up here, it's, okay, like, how's this going to impact stocks and bonds on my portfolio? And as you'll see as we go through this, depending on which lens you're looking through, there's a different type of inflation you might want to look at, and a different one that's going to be more important and relevant to your situation.
Yeah, and I just think it's worth highlighting here that the Fed fights inflation by slowing the economy. The economy and the stock market are two different things. Now, as we saw today, sometimes what the Fed says, what the Fed does, can have an effect on the stock market as well, good and bad, based on the market's expectations of those same events. But what they're really trying to do with the moves that they make is to slow the economy or speed it up with different moves. Just making that distinction, I think, is important for clients, is that the economy and the stock market are two different things. They can have some correlation, and often they do. So
absolutely. To go even a little deeper on that, I would say, the stock market is trying to predict the outcome for all these companies that are the main, operators in the economy. But the stock market is trying to price in all the information about what has happened and what will happen, right? Economic data is as it's happening, we get it released. So, the Fed is trying to influence the economy. That will influence companies, but the stock market is typically forward looking. So it's going to anticipate things that happen in the economy before they actually happen, typically. And to your point, the Fed, their only tool to kind of dampen inflation is to raise interest rates. And by raising interest rates, they make it tougher to borrow. And by making it tougher to borrow, there's less money floating around. People buy less stuff. They lower overall demand in the economy. And so that's what we mean when the Fed is fighting inflation. They are intentionally trying to slow the economy. And as you can imagine, that's a pretty tough job. They're trying to slow it enough to stop inflation, but not so much that they cause other economic harm. And without trying to be too much of a market psychologist and stay too long on this slide, that's sort of part of the reaction you see in markets is markets are wondering, okay, how much is the Fed going to raise interest rates? How much is the Fed looking to, dampen economic activity to get inflation under control? And how much will it have to?
Sure.
So jumping on to the next one.
I'm just going to pause real quick. AJ, all good? Okay, great.
So this is inflation year over year. So if I was just a normal person on the street asking what is inflation, I would look at CPIU, which is just all prices, includes food and energy, and I look at the year-over-year number, right? Because monthly data is noisy, up and down, and this is really what people are feeling and experiencing. So I drew a red line here. Our current inflation is running about 8.2% in August year over year. You can see we've been above this level 4 times in the last 70 odd years, and so above this level quite a bit in the 70s, and a couple of times in the 50s, actually after World War II. We had a blip just before the great financial crisis up to around 5%, a little past 5% in 2008, and up towards 6-ish in the kind of early 90s. But that's sort of what I would think of if I was a consumer, is 8% year over year is where it's been at. Now, just looking at recent history, it's that same number. You can see we almost hit 0% inflation during the depths of COVID. So it was a pretty big whiplash. I mean, prices basically stopped going up, which is something, we're not talking about deflation today, but deflation is pretty bad news as well.
Mm-hmm.
And so there's a lot of people in the midst of COVID wondering, hey, are we going to have epic deflation that we have to deal with? Obviously, the exact opposite is proven to be the case. Inflation has come up quite a bit, and you can see, we see it peaked in June. There's no telling that it won't necessarily, go up again. We're not saying that we're calling it. That's definitely going to be the peak no matter what, but if inflation continues a downward trend, it will have peaked in June. So now we get into the other stuff. So all kinds of other things you hear on the news. You hear about core inflation. You might have even, if you get really deep in the weeds, hear about something called PCE, which is personal consumption expenditure. It's a different version of inflation that the Fed actually looks at. And so to really quick talk through these, the blue line is inflation. It's what you guys experience every day. It's prices of things that you pay for out of your pocket, including food and energy. So that's, I have market and consumer on here in the top right, because the blue line is the kind of consumer line. The market reacts more to changes in the green line and the red line. And the reason is the green line is actually the one the Fed looks at. And so that's PCE, and it excludes food and energy. And the reason the Fed excludes food and energy is because they're so volatile, right? Like if the Fed is looking for a number that is going to help tell them what inflation might be next month, looking at energy doesn't really help them do that. And we've experienced that so far this year, right? It ran up huge at the beginning of the year. It's come down to some extent since then. And if the Fed was constantly raising and lowering interest rates every time the price of a barrel of oil changed, it'd be a really hectic situation. So the Fed cares about the green line, and so the markets care about the green line, because again, the markets care about how the Fed is going to react, how they're going to try to slow economic growth for inflation. And so you saw that in this last month, you saw core inflation go up a little bit, that red line, while kind of normal inflation came down a little bit. The market reacted poorly because again, core went up, even though we saw gas prices decline. The Fed wasn't taking a victory lap. One last, super in the weeds detail, the difference between the red line and the green line. So the red line is CPI, which you hear on the news, less food and energy. And again, the green line is PCE, which is what the Fed looks at. And there's some really nerdy differences between those two numbers. The green line includes stuff like amounts that your insurance company pays on your behalf to doctors, where the red line doesn't. The green line takes into account the fact that you might substitute goods. So say the price of bacon doubles, maybe you buy, sausage instead at the grocery store. The red line says you're not going to substitute. The green line says, well, in the real world, you do substitute sometimes. So that's just something to think about, is when you hear about the Fed's inflation target, they're targeting a number for that green line, not the red line, and not necessarily the blue line.
And as we can see in the chart, the green line is what, about 2 weeks delayed from the red line.
Yep.
Is why we don't have complete data on the green line. So that may be even more of a reason that the market really likes to look at the red line versus the green, because we want, when the market is consuming data, they want the most recent relative data possible.
Absolutely, and that plays perfectly to this next slide. So monthly inflation. So if you're a consumer, I took the consumer part out of this, because if you're a human being and you're asking, what is price changes, what price changes have I experienced? Monthly data is all over the place. It makes sense to look year over year, but the market is reacting to monthly data. And the reason is because that's the only new data, right? So if I calculate year over year inflation for August, well, before the August number even comes in, I already know 11 out of the 12 months, right? So only 1 month worth of data is new when I'm calculating year over year inflation. And that's this monthly piece. And so the market, when it's trying to kind of read the tea leaves of what inflation is going to do, how the Fed's going to react, the market is reacting to these numbers. And so as you can see, the market, 1 month before this, where that blue line dipped below zero, and the red line, you can barely see it, but went down just a hair there. Market reacted pretty positively to that. Well, this last month, where you saw the blue line shot up a little bit again, the red line went up a little bit, the market reacted pretty poorly to that. And the reason is, you might look at the blue line again and say, well, okay, inflation month over month, if I annualize that, it was 0% the month before, and it was below 2% this past month. Isn't that good? Isn't that what the Fed wants? And the answer is no, because the Fed is looking at, again, the green line's not filled out yet, but it tracks the red line pretty closely. The Fed looked at, and the market looked at that red line and said, okay, the core goods, if I exclude food and I exclude energy, that's going above 5% right now. And again, I'm not going to panic when energy prices go up temporarily. I'm not going to celebrate when they go down. The Fed is looking at those core goods. And so that's, again, not the thing you probably see in the newspaper headlines, but it's the thing that the Fed and the markets are reacting to.
And just for clarity for everyone, that 8.2 number, that is consumer inflation.
Yep.
Which would be the blue line.
Yes.
For the past 12 months.
Yep.
Okay. So just clarity on that. Whenever we did the poll to start, we were asking you what you think it could be for the next 5 years. The 8.2 was for these past 12 months of the blue line. So now we're looking at monthly data, which is why you see much more volatility in the blue line. And as you said, Adam, the red line, we take out those things like gas and food, energy and food, which helps us arrive at the red line, which is much less volatile in the blue.
Absolutely. And again, to emphasize, that's not to say that I mean, as a consumer, you should care about food, you should care about energy, and those are prices you pay. But you can imagine just looking at this chart. Let's say the Fed was trying to set, interest rates based on this chart, and see that blue line. I mean, if they raise interest rates a ton 1 month and then cut them the next month and then raise them again and then cut them, they really need a more stable baseline to base those kinds of policy changes on. So that's why they exclude food and energy of what they look at.
That's great.
Okay, so now we're going into we're getting pretty deep in the weeds, like we promised. How does the Fed actually slow the economy? We touched on this a little bit. The Fed is raising interest rates, and the idea is that if they raise interest rates, it makes it a little bit tougher to borrow. Maybe people build less new housing, maybe people finance less cars, there's less overall demand in the economy. If you think back to Econ 101, if you've got a fixed amount of supply and demand goes down, the prices should go down. And so that's really what the Fed is trying to do, is they're trying to pump the brakes on the growth of the economy so that supply can catch up to demand and prices will stop accelerating. And the reason I like this graph, it shows blue is the CPI number we looked at, the consumer one, the kind of tealish line is the 3-month treasury bill rate, which is pretty closely linked to the rate that the Fed influences. And so as you can see, throughout time, when inflation gets high, it's not a new phenomenon. The central bank will raise rates. And you can see sometimes that precipitates a recession, sometimes it doesn't. The other thing I wanted to point out on this chart is the orange line is actually GDP. So it's the value of all the stuff we produce in the economy on an inflation adjusted basis. I just want to point out how wild 2020 was. I mean, you look at this graph, the financial crisis, the 70s, the 80s, the drastic and quick changes in GDP were nothing compared to this recent history. So I'm not saying that says anything specific other than, every time obviously is different in terms of business cycles, but that's just something to keep in mind, really how unprecedented kind of the gyrations in the economy have been in the last couple of years.
Yeah, as well as the increase since then, right? That's a good example of when GDP lowers, when the supply lowers, it's going to have to increase to balance it out.
Yep.
And it did. So
absolutely. So let's go on to this next one. So I wanted to go through kind of 3 historic periods of high inflation and kind of look at inflation, interest rates, what happened in the economy, and what happened in the U.S. stock market to see if there's any lessons we can pick from history about periods of high inflation. And so first, we're going to go to the analogy I hear the most, which is the 70s. So we're starting kind of early 70s here. We're going through kind of mid 80s. And to explain this graph real quick, the gray areas are areas where we were in a recession, which means there's a kind of a technical definition that has a lot of variables to it. The baseline is, GDP is shrinking, so we're producing less stuff, but they also look at things like unemployment and manufacturing, stuff like that. The blue line again is inflation. So you can see, inflation peaked a couple of times throughout the 70s before ultimately coming down and staying, relatively low until today. And you can also see interest rates there. So you see inflation started to go up, interest rates were raised. And you can actually see that first time, the Fed didn't quite commit. So they did bring inflation down to 5-ish%, but they sort of started cutting rates before they really finished the job. And then you can see in the late 80s, for people who are really nerdy, you might remember the name Paul Volcker was the famous Fed chair that came in and raised rates and kept them up until inflation came down. It caused a pretty deep recession in the early 80s, but we came out the other side with a healthy economy and inflation was lower. I think the thing that I see when I look at this graph is the red lines actually show at what point did the market reach its relative low point. And in every case in the 70s, it was before a recession was over. And just to give you an idea, even when a recession ends, we don't know until months later, right? So at the earliest possible point we could know, it's going to be, you have to have a full quarter where GDP is positive, and then you got to wait for the number to come out a month or two. And in reality, the kind of committee that actually says if a recession happened or not, sometimes they take a year or more to say that a recession actually ended. So the message I take away from this is, in this historical analogy we have, the market was forward-looking. It predicted that we were, going to come out of a recession before we actually did. And even, 2 out of the 3 times, when inflation was peaking, the market actually bottomed before inflation started to come So just to reinforce the idea, markets are forward looking, and so it's not that bad news isn't necessarily bad news unless it's worse than everybody thought it was.
Right. Yeah, so the, not only did the inflation and the recession they're not positively correlated, or they're not really correlated at all from what we're seeing. But also what I see is with the gray areas, each of them are different lengths. So we don't know when the recession is going to start. We don't know how long it will be. We don't know when it will peak, and we don't know when it will end, right? Neither does the market, but what the market is good at doing is looking forward and saying, okay, we're seeing the end of this recessionary period, and the market starts to go back up. But we as human beings, there's no real predictable way to time that is what I'm hearing you say.
Absolutely, and just to emphasize that point, we may be in a recession right now.
Right.
Technically, there's this committee that chooses, and they look at all these different factors. But we had 2 consecutive quarters this year of negative GDP growth. Q2's number isn't like final yet, but it probably will be soon. We may have negative GDP growth here in the third quarter. That's still kind of up in the air what'll happen there, but we may find out again that there's a gray bar over this period we've been living through. Sure. And it's not announced until 6 months later. Right. So again, it's the information you have at a time, it's really tough to try to stick the landing on calling the bottom. What I will say, probably the biggest takeaway on this slide and some of the others you're going to see, not to spoil it, is you see that green line is the kind of total return value of the total US stock market. It starts at 100 all the way to the left, it ends at 400 out here to the right. So over this 15-year period, through 3 recessions, record high inflation, the value of stockholding quadrupled over that time period.
For 3 inflation periods, right? Yeah, and AJ just gave me the 425, so we're blowing out our time here. However, I just want something I think that all of us on this call will remember is that 2008 period where you mentioned that the committee often can take up to a year, and in 2007, 2008. I believe it was a full year before they actually said it was an inflationary period.
I've actually got it right here. They were 16 months after the end of the business cycle. It took them a year and 4 months to say that it was over.
Yeah. So not only can we not predict the market based on what they say about inflation, it may take them a year before they can even say it is an inflationary period.
Yeah.
Okay.
It's not an early warning system.
Yeah. Right.
Definitely not that. Okay, so let's go to the 50s inflation. This one's interesting because we're coming out of World War II. We're way back in the day here, right? So Truman is the president at the start of this period. We have really high inflation, and you can see, consistent with the other one, the market has always bottomed and turned around before a recession is over in these historical scenarios. The interesting thing about this one is that rates did not have to come up very much for inflation to go down. So there's all kinds of arguments among economists and things about what's the right historical analogy for this period. 70s comes up most often, and that's obviously the one that most people fear, just because inflation was so high for so long. It was we had a quick run up, but the 70s was 8+ years of really high inflation. It was really tough on people. The 50s, of course, everybody would love to cross their fingers and hope it's a 50 scenario. And people have tried to draw all kinds of analogies to the dislocations in the economy. Maybe they're sort of like demobilizing from World War II, or we shifted production to different sectors, and you can tell yourself all kinds of stories. But I guess the point on this one is, again, markets rebound typically before the end of recessions, and it's not the case that at every point of high inflation in history we've seen that rates have to go really high, and wants to be tons of economic pain for inflation to come down.
That's great. Go ahead.
So my last one, I'll come to the 90s. Inflation was not as high at this point, but what is interesting is, at the very beginning of this period, you had inflation running higher than they wanted it to run. You can see interest rates were raised at that period. We did not sustain a recession, and the stock market didn't even go down at the very beginning of this period. Then later, we kind of had a recession where inflation peaked, but again, rates were coming down before that. And so I think, again, you look at this graph and this graph, the most consistent message across all 3 of these periods is the market bottom before the recession's over. And if you just look at the green line, so from 100 to 400, from 100 to a little over, my eyesight is about 370, 360, 370, and 330. So we're talking in all these decade-long periods with inflation and recessions, the value of the investment in the US market at least tripling, potentially quadrupling, which is why we go back to, there's a lot of fancy ways to say you got to stay in your seat in the tough times. And that is kind of our philosophy and probably our response to everything that's going on right now.
Right. That's great. And we go back to the 70s slide.
Yeah.
We did good on picking up some time there. And I think this can actually shift into our first really two client questions. One was basically, what assets can I buy that will fight inflation and do it well? We have one example here that I'll dive into. And the other question that we had is, what are we going to, are these assets still gonna do that for us? Are our plans still safe? And what this graph tells me, really all three of them do, but this one especially, when we look at that green line through 3 inflationary periods, 3, which is a big deal in 1 decade.
Yeah.
Starts, it almost quadruples over that time period if you're invested in stocks. Now, our clients are invested, most of our clients are invested in some mix of stocks and bonds, and that's why that mix is so important, because if we know that asset can be a great hedge to inflation, then we have to have a good portion of their portfolio, the correct portion of their portfolio allocated to that asset.
Absolutely. And I've got some extra slides I put together. I couldn't help myself.
Of course,
Jay. But because when we got that question, I thought, okay, well, what other types of inflation hedging assets do you hear about a lot? So again, this is the 70s again, and you've got this green line, that's the stock market. Blue line is inflation. So in the 70s, this probably doesn't surprise anybody. Oil went up a ton. So there are periods in the 70s where if you put all your money in oil,
right,
that might have worked out for you. Other things on here, you've got lumber has been something kind of bought recently, so I threw that on there. You've got kind of the cost of housing is that yellow line. So still at the end of the period, the market's going to outdo oil, but oil gave the market a run for its money in the 70s. But you look at the 50s, there's nothing even close. I mean, oil, everything, housing, timber, it's all not really be nearly as well off as stocks. And then the 90s, same story. There's nothing. Timber does a little bit better in the 90s, but it's still going to come nowhere close to stocks. So anyways, when we look at the weight of history, stocks over the long run for a long-term investor are what we believe is best to fight inflation. Now, if you need to guard against inflation in 1 year or 2 years or 3 years,
right,
and you can't, because back to this point, over any couple year period here, if you draw a line on that green line, stocks go down over 1 year, 2 year periods, 3 year periods plus in some points in history. So if you have to have a certain amount of money precisely in a year or 2 years, you might be interested in putting it in something like TIPS, so government securities that are inflation protected. And then my final piece here, if you hang with me, Jay, I know you're probably like, let's get a move on. But I've through the last 30 years. So let's say you put money in stocks or bonds or oil or timber or housing. I won't even say what all the different lines are at the bottom. The important is the green line is stocks, right? So over the last 30 years, there's been tough periods for different assets, but stocks, tend to do really, really well over long periods of time.
Right. Well, and if you look at either one of these slides, I just think, yeah, that's great. So I think it's also very important to point out, I don't think we have bonds on.
We got it on there.
Okay.
The teal line.
Okay, so the teal line is that TIPS?
AAA corporates.
Okay, that's AAA corporate bonds. So this is a great slide since we just talked for 20-30 minutes on inflation and we voted on inflation, which I appreciate everyone doing. And the data that we showed from Fred, that's not to say, oh no, your vote was wrong. That's to say that, hey, these things, yes, they can be extreme at times, but they tend to level out. What I find most interesting and quick to point out, now that we've talked about inflation for that long, is that when you look at this green line, if you're anything like me, I'm like, why wouldn't I have all my assets in that basket, right? Well, yes, they are a great hedge for inflation, but what they also are is, just to reiterate something you just said, is they go up and down. They are volatile in short periods. Over a year, if you need money in 6 to 12 months, we would not tell you to put all your money in those stock assets, because obviously they can be down when you need to access your money. So the very most important thing we can do, we can dive into all these different subjects, and that is our job, to dive into all of our different holdings and to get our clients the best return we can possibly get for their given level of risk that they want to accept. But when we do all that, the most important thing we can do is have that right mix of stocks and bonds.
Yep.
And I think when some folks that I know want to, talk about these different, commodities or things that they can do to hedge inflation, it's oftentimes just because either they've heard it on the news, it's not as sexy as investing in public companies. We sometimes want to get over creative when if we can just get the right balance of stocks to bonds to cash, to real estate, or whatever you decide to hold in your portfolio. If you can just get that right, this data shows us that's a great hedge to inflation, right?
Yeah, and I would actually, I think it's a perfect segue to the second part of that question is how do we know things won't be different in the future? And, I can't predict what will happen in the economy, but I will say that I think, sometimes in boom times in the stock market, some of the feedback we'll get is like, this seems too good to be true almost. Like how would returns in stocks be consistently this high? And the reason is times like these, right? Because everybody, has a feeling in their stomach of like, man, this seems uncertain. Doesn't this seem like a time where there's too much uncertainty out there? Shouldn't hold these assets. They've been down a little bit. Is this still the right long-term plan? And it's exactly that very natural and human instinct that keeps a lot of people from being able to hold on to be long-term investors and to participate in that green line. And instead, they might participate with that teal line or the brown line. And that's not to say that they won't have some return, but to really capture the substantial long-term returns, stock exposure has proven, come rain or come shine in almost all periods to be the most useful tool to drive long-term returns.
Yeah, and to get those returns of that green line, we like to say you have to earn your return. You have to put up with this uncertainty, because if you don't put up with this uncertainty, you'll flee to safety and you will not get those returns. There's been a lot of studies that show that the typical investor, just everyday do-it-yourself investor, far underperforms what the market does because they want to get maybe too creative, or they just get scared in those times that they do have to earn their return. Hopefully we do a good job of keeping our clients in their seats and helping them, not only keeping them in their seats, I don't really like the way that sounds, helping them understand that that's what's happening. You are earning your return. And so yeah, it's just a great slide. And I think it really ties into what we were talking about today. Sometimes, the best hedge to inflation is stocks. Oftentimes we think, and that sounds easy. It may be simple, but it's not easy, right?
Yeah.
So,
yeah, I would say too, to the point of stocks being a long-term hedge for inflation. You think about what inflation is. Prices going up in the economy. And who sells stuff in the economy? Companies, right? So inflation means revenues are going to go up for companies. Now, of course, there's companies that sell stuff to companies, and so those companies represent costs. So revenues and costs go up. So in the long term, inflation is not necessarily bad for companies. It's just they'll charge higher prices, they'll have higher costs. It's really the Fed's reaction to inflation that is bad for companies. But the important thing to remember is the Fed's reaction is temporary, right? They will react, they might cause a recession, but that recession will come and go. And 10, 15 years, nobody's gonna be sitting around talking about, the recession the Fed may or may not have caused in this period of time. But those companies will be charging higher prices and have higher costs. And so again, when we think about long-term, that's where we feel really confident about stocks being the kind of best position to be positioning against inflation.
Absolutely. I see we have about 5 minutes. If we don't have any other questions, AJ, I think we could talk a little bit about that uncertainty and the press conference that we had today. It's kind of an interesting example, but AJ, any questions from the group at this time?
If you've answered the 2 client questions that were
cool. So just real quickly, like I say, we only have about 5 minutes, but today Powell had a press conference and we saw the market, you especially saw the market go up a bit. And to me, I'm going to let you expand, but to me, when it was going up, what was happening is maybe either what we expected to happen wasn't as bad. So we were removing a little bit of uncertainty. And then when the tone of that press conference changed, and this is us interpreting what we think happened. I mean, there's no fact to this, but it sure seems like when the tone of that press conference changed, that's when the market started to dip. So I don't know if you have any thoughts on that, just real quick, just for fun.
Absolutely, and I would say, I just want to reassure everybody, we are not like trading accounts based
Yeah.
on like every single word that comes out of
Yeah.
Jay Powell's mouth in that press conference. But I mean, it impacts what we do professionally. So I do watch the press conferences after they release what they're going to do with interest rates. And so, yeah, it was really wild to see. You saw, I had the market pulled up on one screen, and I had, Jay Powell talking live on another screen. And basically, what happened today was, stocks were up a little bit, and then the Fed released a press release of saying, hey, we're going to raise interest rates, 0.75% right now. And one of the surprises in the press release was, hey, we might end up with a little bit higher terminal rate, which means kind of the rate that they go to before they stop, than we said we would last time. So they're thinking maybe we're going to have to raise rates a little higher. So that press release came out, the minute it came out, markets went down about 1.5%. Then Jay Powell comes out, gets to the podium, and as he starts speaking, the markets start going back up because he's saying things like, there's a potential at some point that we're gonna have to reassess and pause. And I mean, it's parsing the most nuanced things that he said, right? Like a normal person watching that would be like, I don't understand what was so significant about what he just said. But when he uses little phrases, I mean, you can just see the market move on him. And that's not to say we should be trying to trade what Jay Powell says in second by second, but just to emphasize your point of like markets are forward looking. There are hundreds of thousands of market participants incorporating every little piece of information that comes, and the markets react like that.
Yeah, and in fact, I think it's a good example of why we don't trade every minute of every day. Because one thing we know for sure, if we try to do that, we're going to drive costs up, we're going to drive time costs up. And this example was an example of all the market is doing here is reacting to things that are already priced in the market. And are they as bad as we thought they were, or are they not? And it's reacting to uncertainty. Oh, they released a press release. That could be scary. That's uncertainty. When he gets to the podium, there's at least a little less uncertainty because they know he's there actually doing it. So those short-term events to me are actually a good example of why we don't want to trade daily, because the market is going to do this and that. So we may have a quick question here.
Yeah, we had a question come in that says, if the Fed raises the rate to slow down the economy, what happens if the government spending / money or I'm assuming they're asking what happens if the government spending or student loans go up?
Gotcha. Yeah, so that's an interesting question because we're talking about the Fed raising and lowering rates, and it's like who pays for those rates, right? And the primary person that pays for those rates is the U.S. government, right? Because the U.S. government has a lot of debt outstanding. It's an asset that's traded around the world, held by foreign countries as their reserves. So other people in the economy also pay those rates. And so the interesting thing is, so as the Fed raises rates, the U.S. government, the cost for the U.S. government to service their debt will rise as well. And so you think about, some people could paint in their head a situation where, okay, like, does that, I cast that forward in my mind, the rates go up, we already have a lot of national debt, and interest costs go up. Do we get into kind of like a debt spiral with the U.S. government, where the U.S. government, the interest rate gets higher and higher and higher to where it crowds out other spending in the budget, and the U.S. government, you can think of doomsday scenarios in your head. The thing I would point out, though, is the interesting thing is while rates have gone up, and this is not a really reassuring story for investors necessarily, but rates have gone up, but inflation has been 8%. And so you think about debt in times of inflation, right. The government went from paying maybe 0 to 1% on short-term borrowings now to 3 to 4%. But inflation was 8% on all the debt they have outstanding. So the government, as long as inflation runs high and is higher than the interest rate they're borrowing at, the government is actually, quote unquote, making money by having debt outstanding. And that actually applies to everyday consumers too, right? If you pull a mortgage and there's high inflation over time, well, the value of your house is going to rise, the value of the mortgage stays the same. And so inflation is typically good for debtors. And so anyways, to address that question, the worst case scenario for the U.S. government would be inflation comes down, but for some reason the Fed leaves rates really high for a long time, so that they're not inflating away the debt, but they also owe a lot of interest on the debt. So many other factors that go into the economy, but I think that's always worth pointing out is like, you can think of a lot of doomsday scenarios in your head, but sometimes they're mutually exclusive, right? We have record high inflation, not great for investors, but the government doesn't need to worry as much about the debt.
And those two really balance each other
Yeah.
out, right?
Two sides of the same
Which
coin.
is a good thing. And that's why the Fed, there's some smart people there.
Yeah.
So, I think we are at time and, just again, appreciate everyone being here. Had great participation today. Any closing thoughts?
I don't think so. Always feel free to reach out with
Yeah.
any other questions. We're always happy to follow up. We love doing this kind of stuff and diving deep, but we also know, at the end of the day, what it takes to be successful is not, necessarily to look at all these detailed graphs. We're happy to provide the context and color, but really to answer your questions, whatever questions you have about your assets, your portfolio, your plan.
Absolutely. Any questions, feel free to reach out. Also, any future topics that you'd like us to address, please feel free to email anyone here. And we would be more than happy to address those next time. Thanks, everybody. Have a great afternoon and evening.